On this is our week of serviced accommodation Q&A, and I have the fantastic Usman Nazir here, who is going to talk all things capital allowances. And if you don't know anything about capital allowances yet, you really should, because capital allowances and serviced accommodation go hand in hand. And so it is a brilliant tool to know. And obviously, with all these things, it's really, really key to have specialists. So we will, deep dive into why you need specialists as well. So Usman, welcome.
Thank you, Emma. Thanks for having me.
Yeah, no problem at all. Well, look, would you mind just giving us a quick intro into who you are, what you do, and then we'll jump into getting some questions asked.
Okay, so hi guys, my name is Usman Nazir. I'm a capital allowances specialist. I've been doing it since 2005, I think, 2004, since I left university pretty much. I've never looked back. We've been working for ourselves privately for, I think, since 2012. So we had our 10-year work anniversary, some anniversary. Matt lives in the Isle of Wight, and I live in Bedfordshire. So yeah, it was just in those, but yeah, 10-year, big milestone for us. I love it. I love doing this job. I'm fortunate, one of the fortunate few kind of people who does something that they enjoy doing on a daily basis. Everything about it, it was tailored for me, and I just like being able to be an office monkey and actually get out of the office and do things, go out on site visits and meet people and all the rest of it, which is strange considering I generally am quite miserable and I hate everyone, but it's fine. I feel like it's changed me a little bit in that regard, but yeah. For another best thing to put on the profile, but yeah, I generally am not a fan of people. I'm not people friendly, but the job has forced me to get out of my comfort zone and network a lot more. So let's get into what capital allowances are. So capital allowances are a HMRC approved tax break that you are entitled to claim. It's been enshrined in UK legislation since the 18th century, and it's just evolved over the years to where it is in present day, and it changes every time the budget gets announced, every time a new prime minister or a new party gets into power, and there's always some kind of tax changes constantly being implemented. So we have to adapt and change the rules. So it's never the same. It wasn't what it was last year or the year before. It's just constantly adapting, and my job is to put the information out there and keep you guys up to date on all the ins and outs and the nuances of what you're entitled to kind of claim with your properties. So we're focusing specifically on serviced accommodation today. So an overview of capital allowances, essentially you've got a building. And it can be any building. You can claim capital allowances on any commercial property, but we're going to focus purely on service accommodation. So you've got let's say a one-bed apartment, for argument's sake, that you've bought as a leasehold property. All of the integral features, all of the plant machinery embedded within that property, you inherit as part of the purchase. So everything except for the structure, we can claim capital allowances for. So you look around your property, you've got bathrooms, we can claim capital allowances on every single bit of appliance in there. So everything from the WCs, wash hand basins, towel radiators, shaving points, mirrors, lights, extraction fans, the shower cubicle, the bathtub, we can claim capital allowances and all that. Same for the kitchen, everything from the counter to the base units, the wall units, the cooker, the microwave, the washing machine, the dishwasher, all of those things are subject specific for business or service accommodation, we can claim capital allowances on. And it's not restricted to that. We've got lighting throughout the property, we've got heating, we've got ventilation, we've got wiring, we've got switchgear, we've got all the incoming mains, water, data, gas, electricity, we've got flooring, carpet, laminate, vinyl, we've got the boiler systems, the cold water plumbing, hot water plumbing systems, all of that embedded throughout the property. That's what we can claim capital allowances on. And all we do is we claim that back as part of the expenditure that you incurred on either buying the property or doing it up, so that you can utilize it in your tax returns, and that same expenditure you can recoup as tax relief, making your business more viable, allowing you to retain more of your income, reinvesting it into more properties, or just keeping it in your pocket and making the business more viable. And that's all it is. It's just a tax break to wipe out your tax bill. And typically with service accommodation, with the amount of allowances that we identify in purchases and refurbs, we tend to make most properties tax-free for the first 2 to 3 years, which is quite significant considering the margins can be quite thin in the first couple of years. But if we're wiping that out and allowing you to retain your income for the first few years of trading, then it makes the business just that much more viable if you're able to do that. So you can scale up a lot quicker, knowing that you're able to retain as much of your income as possible for the first couple of years of running a property. That is it in a very generic kind of nutshell. Obviously, there's much more detail and delve in the detail, but that's the general overview, and it's not much more complicated than that.
Wow. So you speak incredibly quickly. If anyone missed that
down so much, you wouldn't believe that, yeah.
Oh, well, that's amazing. So Okay, so let's, so there'll be people in here that, are really experienced, but likewise, there'll be people in here and those listening on replay as well, who will be kind of very, very new and potentially not even very knowledgeable about sort of the accountancy side of things. So if we could just sort of dumb it down a bit, just make it, a little bit simpler for people. So inherently, when we're talking about, not tax-free for say 2 to 3 years, so can we just sort of perhaps walk through that process of how that might be? So and this is guys also for properties that you own inherently, so it's really key that there's an ownership there. So if we talk about it, so you're there and you're like, if we just give an example, there's somewhere on the Cornish coast, because my son was there at a festival, he survived, thank goodness, this weekend. If you're buying a place, clearly a holiday place on the Cornish coast, and you're going to run it as serviced accommodation or as a furnished holiday. Like what's kind of the process that one might do to be able to look at these capital allowances?
So typically, a typical scenario would be someone will buy a furnished holiday or a service accommodation, whichever of the two. So let's just say you're buying an apartment on the seafront or wherever it might be, somewhere in the Cornish village, one of the Cornish villages or so. You bought it for, say, I don't know, let's say just a ballpark figure, 350, 400k, yeah. And it's in relatively good nick, just needs a little bit of kind of updating. All of the plant machinery within it, whether you're going to strip anything out or not, in its current form, we can claim capital allowances and all of that as pre-trading expenditure to the business of serviced accommodation. Now, it's a residential property, essentially. That's what I love about serviced accommodation, because typically with commercial properties, we have to do some background research, some diligence to establish your entitlement to claim, whatnot, all the restrictions to claiming, making sure that, there's no covenants in the contract restricting you from claim or someone's claimed previously. But with serviced accommodation, typically you're buying a residential unit and you're bringing it into commercial use by running it as serviced accommodation and bringing it into hospitality use. So you're the first person who's entitled to claim. So there's no restrictions to claiming whatsoever. So there's no diligence to be done. All we need to do is just make sure that you're going to hit the qualifying criteria in order to be able to claim capital allowances, which we'll get to in a second. It's fine. So you bought that property, you've inherited all the plant and machinery. We can claim capital allowances on every single bit of all the bits that we mentioned a little while ago. You then come in and say, maybe just
Deborah has said, Usman, please can you slow down? You're on kind of 1.75 speed, maybe 1.5. Can we bring it down to maybe 1.25?
I promise nothing, but okay, fine. So if
she said, please slow down.
Let's say, okay, so you're just going to do a cosmetic refurb of sorts where you're just going to paint it, redecorate, new furniture. You may even just replace one of the bathrooms just to get it up to scratch for service accommodation. But we claim everything on the property that you inherit as part of the purchase. If you then strip parts out and you replace them, bathrooms, kitchens, whatever, that's a whole separate value expenditure. So we're just making a claim based on the original purchase of the property. Now, on that 400k worth of a purchase, we'll probably find you about 100 to 150,000 pounds worth of allowances just on that, all the stuff inherited within it. So that's one pool of allowances identified, put to one side. Then you've done the refurb of the property, I don't know, a new bathroom, a new kitchen, maybe like the new furniture, some new lighting and a bit of rewiring, maybe another 30 or 40k, something along those lines, maybe even 50. That's a separate pool of allowances that we can identify, expenditure that we can identify allowances from. Because it's all a fit out, the majority of that refurb works qualifies as well. So we'll probably find about 45,000 pounds out of that 50k. The other 5,000 is probably non-qualifying, but a significantly large amount. Add that to the original pool of 150k, we're just shy of 200,000 pounds worth of allowances now. So we would produce a HMRC compliant report, which breaks it all down, and we submit that to you and your accountant. They literally just submit that figure into your tax return, the first year's trading. So there's no time restriction on capital allowances. You could have owned the property historically, or there is a benefit to claiming in the first year, which is the first year relief, which is currently capped at £1 million. So that 200,000 is within that £1 million limit. We can submit the full £195,000 worth of allowances in the first year and just carry it forward to create a loss. And essentially for you as the SA operator, the next £195,000 worth of rental profits, you don't have to pay any tax on. And it's literally as simple as that. It's almost like an expense. You just add it to your already kind of gathered expenses and you just create that expense, create a loss, carry it forward until you've exhausted the full amount. So however long it takes for you to earn £195,000 worth of rental profits. And that's obviously down to how ambitious you are with your business.
Amazing. So when you talk about, so if we talk about sort of percentages here, just to give sort of people an idea, is there a general kind of percentage of capital allowance on, say, a property that is for serviced accommodation, which you talked about your one sort of pre-trading expenses, and then you talked about the sort of the refurb and all of those kind of things? Are they different?
So on a purchase, typically we're looking between about 20, maybe 18% low end to like 45% high end of the purchase price. I've done as high as 45% low end. It all just depends on how well kitted out your property is, because you get some that are quite thin, don't really have a lot going on inside them. So people will do a claim and it'll come out at 18%. People will wonder why it's so low. It's just because it just isn't much in there, unfortunately. But then you get some that are just all singing, all dancing, and have got everything high end in there, from the lighting, from the bathrooms, from the kitchens, and everything the way it is. And we do it based on the replacement value of those items. And we can find a fairly high end claim, especially if the person's underpaid for the property. That has an effect on the multiplier for us claiming, identifying capital allowances. Could also be the same if you've overpaid for the property. That has an effect on the multiplier for us identifying capital allowances, which will reduce the amount of allowances available. But so yeah, there is no standard set figure. It varies all depending on the nature of that property.
So that's interesting. Underpaying and overpaying, is that a benefit either way, or is underpaying not of a benefit or overpaying of a benefit?
So it's not something that I would get into, only because it is what it is. When you're buying a property, you're buying it based on its merits and whether it's going to generate you that income for service accommodation. The capital allowances should only ever be seen as a cherry on top. I know I'm dumbing down the service I'm providing, but it is. The numbers need to stack up on their own before the capital allowances come into play. We just make it that much sweeter by allowing you to retain all of that income. But the numbers don't stack up before. The capital allowances definitely shouldn't be the deciding factor. They need to stack up regardless of the allowances. With regards to overpaying, underpaying, we get this a lot when people buy properties in the northern part of the country where properties are significantly lower than they are in the southern part of the country. So if you're buying a leasehold apartment in London, for example, you're massively overpaying just because of the location of where it is. I mean, the flat isn't worth, the build cost of that apartment certainly isn't worth the purchase price. So we're doing it based on the replacement value of those items. That's what capital allowance is all about. Now, if you're buying a one-bed apartment for like 1.2 million, so I'll give you an example. I did it was like so they had 3 1-beds, 2 2-beds, and 1 3-bed, and it was in Covent Garden, and that's what it was. So it's just 6 apartments. It was 9.9 million the purchase price. So we went in there, but it's just because it was in Covent Garden, right? There wasn't anywhere near that amount of capital of integral features within there. It was just the build cost and everything else that we had to do it based on. I think in the end we found like about, I think it was like just about £280,000 worth of allowances, which is insane based on, but that's all it was. When you rate all the plant machinery that was embedded throughout those properties, that's all it cost for those items. Everything else was just the land value, the location, and the cost to build the unit where it was and everything else. So it all depends on those kind of variables. Whereas up north, 9.9 million would get you something significant, and I'd probably actually find you close to like 30% of that. We'd probably find about £3 million worth of allowances, because it would genuinely be about that kind of price. It's just things are overinflated down south and it's different up north. So that's something else just to bear in mind as to why your allowances might be lower or higher based on the location. And it's the same for prime areas, like you mentioned, the Cornish kind of village areas and stay there. It's premium. It's going to be a much higher purchase price there than somewhere else, obviously.
Fantastic. And just stepping back again, because it was quite quick to start with, can you just reiterate plant and machinery? So it has to be, a qualifying activity, and it's the plant and machinery. Can you kind of explain those terms for us?
So qualifying activity, so you have to have to hit the milestones for claiming capital allowances. You have to have the qualifying trade and the qualifying activity. So to qualify that residential property and bring it to commercial use, you have to put it into commercial use. So the trade is the property, so you own that property, and it's serviced accommodation that is the activity that brings it to commercial use. So you have to have both of those. So that's the first thing. And plant and machinery is literally just an exhaustive list of all the things that qualify. So you've got everything from electrical installations, mechanical installations, all the kitchenware, sanitary ware, flooring, heating, ventilation, plumbing systems. In offices, you've got things like elevators, and you've got a specialist kit there. You've got fire alarm systems, you've got security systems embedded throughout the property. You've got air conditioning systems, you've got speaker systems in banqueting halls, you've got specialist kind of light systems and sound systems. All of that kind of stuff qualifies. So that's when we're talking about plant machinery, everything that's subject specific. Even in a care home, you have the kind of Stairmaster kind of stair lifts for residents, that's subject specific. So that's a piece of plant machinery. You've got a special hoist to hoist patients in and out of the bathtubs that they have in care homes. That's specialist plant machinery. So all of that kind of stuff. Industrial kitchens in care homes because they're having to feed quite a significant amount of patients. Again, that's plant machinery. So it's all of those kind of bits. The only bits that we're not counting is the bricks, the mortar, the structure, the windows, the roof, all of that stuff. But everything else embedded, inherent within the property, that we can claim capital allowances on.
Amazing. And what about things like sort of, so those are kind of embedded. What about sort of furniture, any of those kind of things? Can that be included?
So you can claim, I mean, so in offices, you can claim on office equipment. We typically don't claim that because they're the low ticket items that the accountants can claim. We're going for the specialist items here. But in your service accommodation, it's, yeah, I mean, all of the furniture is subject specific because it has to come furnished. You're not going to do an unfurnished service accommodation unit. So all of that stuff is subject specific. Everything from picture frames on the wall, because it all provides ambience for the kind of setup of that hospitality business. So if you can claim it in a hotel, you can certainly claim it in a service accommodation unit. So all of those bits that are specific to that trade, we can claim capital allowances on. So you might buy a brand new apartment, doesn't need anything doing to it. The only thing you're going to do is fit it out and kit it out with furniture. We can claim that'll be your refurb cost. That'll be your additional expenditure, fitting that property out with furniture, kitchenware, and all the rest of it to get it up and running. And we can claim on all that for service accommodation, certainly.
Amazing. Okay, so inherently you have to have a qualifying trade, and for us that's service accommodation, and then you have to have qualifying bits and
activity,
pieces,
which is the business of service accommodation itself, which is exactly that, the short lets.
Fantastic. And then you spoke about this, and does it matter if it's a flat, a house, any of those kind of things? Is it just literally something that you use, that you've purchased, a property that you've used to purchase, and you run it, you change it to service accommodation?
Exactly that. So it could be any type of residential unit that you've converted across. It could be an office to resi conversion. It could be anything along the lines. It could be a block of apartments that you're running all now as service accommodation. Whatever it is, again, it's just the trade and the activity. As long as you're providing both of those, it's service accommodation. So it makes no difference as to whether it's an actual house, a terraced house, a detached house, a 1-bed apartment, a 2-bed apartment, 3-bed, wherever it may be. It's all the same. They're all residential units. They just have their own kind of merits.
And just for everyone's benefit as well, does it matter what the planning use class is? So if it's C1, C3, so C1 would be, hotels, guest house. C3 is basically residential. Does it matter for claiming capital allowances in either of those areas?
We would typically prefer it to be C1 just for the case of if HMRC were ever to inquire into the figures for whatever reason, which is fairly, it doesn't happen very often, but say they were to, it just strengthens your case because it is running as a hospitality business. But it's not a requirement. I mean, I'll be honest, probably about 99% of all the cases I do don't have C1 use. They just use it, leave it as it is, because it's just, unless there's a need to do it, no one really does it, right? So if I said, right, to claim the capital allowances, you need to convert to C1, then they'll do it, but I don't need it to do that. Again, as long as you can confirm that you are doing that qualifying trade and the activity, that's good enough. And I can just see from the bookings and everything else and the money coming in and the fact that you've got short-term lets on there and that's the trade that you're running, that's sufficient for HMRC purposes, certainly just to claim capital allowances. So we don't really need the change of use, class use. Like I said, it's always a good thing to have just for long-term audit purposes, but it's not a necessity. It's not a requirement. It certainly isn't.
Fantastic. And so what about the qualifying criteria then? So I know we've spoken about the activity and things like that. Is there a sort of a time scale that we have to look at?
So you want to make sure that, so I think the criteria is, so it has to be available for like 210 days of the year. It has to be let out for at least 105 days of the year and no lets over the 30 days. So it has to be kept that way. That is a qualifying criteria. We have had scenarios, I mean, COVID certainly, whereby people are doing a mix of kind of long-term lets and short-term lets just to get their money coming in because people were isolating and all the rest of it, in which case we have to deduct the income that was incurred from non-qualifying bookings and then obviously just do an averaging election against those and the ones that did qualify. So we do get cases like that, but that's typically the criteria that we need in order to satisfy it being service accommodation or a holiday let.
So that was 210 days that is out, say would it like booking.com, Airbnb, something like that. And then you have to show, and obviously if it's something through a website like booking.com, you can give proof that we have had this many short-term bookings that fulfill the criteria of under 30 days to enable us to have the 105 days, which means we can now claim it.
Which is what HMRC asked for, but I'll be honest with you, in all the years that we've been trading, they've never asked for the bookings. I'll be honest, the only stuff they ever look into is the ratings that I use for claiming the capital allowances, because the only thing they're concerned about is the money they're paying out. They don't care about whether you're hitting any other criteria. It's about the fact that, right, what we have into, what can we restrict these guys with? And it's just about the rate. So they'll come back and they'll ask questions about, oh, your rating for lighting was too aggressive, or your rating for the land is this and the other. And we always back it up. I'll only be as aggressive as I can be, as much as I can back it up. So it'll be a bit back and forth saying that, no, this is the rate that we use based on this, and here's the evidence of the lighting, and there's the evidence, blah, blah, blah. And we'll argue back and forth, and there'll be a bit of give and take. But typically, they always want to just try and downgrade the claims as much as possible. And we don't, I'm like a dog with a bone. I won't reduce the claim any which way, shape, or form, because the results that we found and the numbers that we've quantified are based on evidence. Yeah. So why should we be reducing the allowances? It's for the duty of care is on them to prove that something I've done is wrong, and for them to downgrade the claim. And I think in the last 10 years of trading that we've been doing it for ourselves, we've only ever had 2 claims that have been downgraded, and they were multi-million-pound claims. And those are the ones that they're really looking at, because that's where they're paying out stacks and they want to reduce us. And even those ones, they I think the maximum kind of downgrade we've had was 27,000 on an 18 million pound claim. And I was arguing that as well. And the client was like, just let it go. And I was like, but it's not though, because
it's the principle.
Exactly. I mean, the only stuff HMRC can get me on is land values, because I'm not a DV and their district values are a lot more, refined and up to date than we are. So typically, if they're going to argue something about land, I might let them have that, but that's as much as I would let them have.
Fantastic, fantastic. And yeah, we've got a good question here. So does that mean it doesn't work in London with the 90-day rule?
The 90-day rule is there. In all honesty, they will operate under the radar. They don't care, because no one looks at the bookings, right? Like I said, they just carry on. That is the rule. But to date, I don't know anyone who adheres to it. I know that is like how it is. But if I'm giving you real information on the streets, on the ground, they just carry on as per normal. Otherwise, how would it work in London? Do you think they all shut down after 90 days? No. Hell no, they just crack on for the whole year. How and why and where they get around it is a story for another day. But no, they just crack on. And I think there was a thing recently, right, where HMRC have asked for access to Airbnb bookings, or was it Booking.com's kind of thing? They have access to that.
Yeah.
Nothing's come of that from my experience either, to be honest with you. But yeah, everyone that we've done a claim for in London certainly doesn't adhere to the 9-day rule. I'll tell you that now.
And what's the difference?
I'm not advocating that you guys should do the same thing, right? I'm not saying that at all. You asked the question. I'm just saying, on the street, on the ground, the fact is that these guys are operating and they're doing the same as you guys would be doing it up and down the country. They're not adhering to these rules because it doesn't work otherwise. And London is a goldmine for service accommodation at the minute. It is everywhere and it is absolutely firing. So none of these guys are adhering to that. Okay,
so we better say there are definitely people adhering to it, and we advise you to stick to it, but whatever you choose to do with your business is fine. So going on to
nothing.
exactly. And what about so we have what we generically call in kind of our property industry this serviced accommodation, and then we've also got furnished holiday lets. Can you kind of give us a bit of an understanding of the differences between the two? Is there a difference?
So only from my experience, I can only vouch for like the kind of things that we come up with. So typically it's the same thing. I mean, the rules are the same. It's still, short lets and the kind of criteria with regards to 210 days, 105 and 30, nothing over 30 is the same thing. But from what our experience gathers is, furnished holiday lets the income is usually ring fenced. So any allowances you identify on that furnished holiday let, you can only use against the trading profits, rental profits from that furnished holiday let, and that's it. With serviced accommodation, it's slightly different in that people tend to do what's called sideways relief. So if you have, say, £100,000 worth of allowances and you've only used maybe 10,000 of those allowances for that one tax year, there is a potential to offset some of the other allowances against your PAYE income. there is possibility to do that. Doesn't work for everyone, but there is that option, and you can only do that with service accommodation because that's not ring fenced like furnished holiday lets. But then we do ask people to make the differentiation between furnished holiday and service accommodation, because service accommodation is that it has to be serviced. There has to be some kind of service provided, and the way we clarify that is the same as a hotel. Like you book into a hotel, there's a concierge there that books you in. There's a food service, you know, there's a room service kind of element to it. Does your service accommodation hit that kind of criteria? And how do you get around that? People tend to typically get around that by just sticking a tablet in the service accommodation, so you can order stuff from, you know, approved kind of takeaways on Just Eat and all the rest of it. And then all of a sudden you've got like a room service element there. You know, it's basic and it is, you know, what it is, but there's that. Or they just chuck in like a breakfast service, so they'll put in like a Kellogg's variety pack or all the rest of it in the kitchen. All of a sudden you're serving breakfast now, and that's the differentiation between it being serviced and just a normal holiday let. So there's things like that you can do. Again, I'm not a service accommodation specialist or professional to advocate this stuff, but that's the kind of stuff that I see, and how people separate the two in my experience. Typically, the furnished holiday lets are more often than not, the ones that we do in Europe, don't really get too many serviced accommodation units in Europe. There are some, but typically those are furnished holiday lets because their income is ring fenced to what they are. And that's just to get experience. It doesn't mean that you can't do service accommodation and that variation in Europe as well. And just to mention, you can claim capital allowances on holiday lets in the European Economic Union. Until Brexit screws it up again, I don't know. But for now, everything's fine, and you are able to do that as well. Holiday lets abroad in Europe, you're allowed to claim capital allowances on just fine. Yeah, and that's the only commercial property that we can claim capital allowances on in Europe, just holiday lets.
Amazing. So basically, if you've got a holiday, you know, second home in somewhere in Europe, you're obviously renting it out on a short-term basis, you can claim capital allowances. So go and do that.
Going back to the UK, yeah, absolutely.
That's amazing. So just going back and just to clarify then, so with a furnished holiday let, that literally is the business. So the business that is running that furnished holiday let can only offset it against the business. But if it's serviced accommodation, and we offer such, like you said, this room service and like a tablet, guys, that would be something like Your Welcome tablet. So that's where you have a tablet inside, you can check in, they can find out how to use how to use the toaster, the oven, whatever it is that you've got in there. You can look at places to go, but you can also order food via, say, Just Eat or something through a tablet, and one of them would be called something like Your Welcome. That allows you to say that you're offering these extra services where you can then potentially, obviously it all depends, and we're not giving advice here, but it depends on your own personal circumstances. You would speak through with your accountant, and there is a possibility of utilizing any unused capital allowances against your own income.
Possibly. Again, we're not confirming this, but all I would say is, like, look at it how a hotel is run. Try and replicate that model in your service accommodation unit. And if you can replicate all of those, the merits of the kind of things that qualify a hotel in your service accommodation unit, then there is a possibility of sideways relieving. There is also the requirement to hold it in a relative entity as well that qualifies. So you want to hold it in your personal name or in an LLP. That'll give you the opportunity to sideways relief, because obviously that way you can sideways relief. If you hold it in a limited company, then again, the allowances are ring fenced to just that limited company. So there is that too. But again, this is something that people need to discuss with their registered tax agent, their accountant, because only they can advise on this. I wouldn't know anyone's circumstances, and that's not me passing the buck. I genuinely don't know, because me and you could both have the same scenario, buy the same property, but I hold it differently to you. You have other assets, you have other income, I have other assets and other income, and there's something that I do that restricts me from claiming sideways relief, whereas you're open to be able to doing it. So it's a conversation. So a lot of people, I know I do get this a lot. I get a lot of people coming looking to claim capital allowances on a holiday let, and they have no intention of actually using the allowances against the holiday let income. They just want a sideways relief against some massive hench PAYE income that they've got coming in and the tax bill for that. That's fine. I mean, if the rules are there, then you're able to do that up to a limit of 50,000 on a yearly basis. You can do that. We get that a lot, but it's not something I would advocate, because we get a lot of people trying to just do that, and you can get caught out if an audit is to take place or an inquiry by HMRC.
Yeah, so you've got to be doing it the correct way, so to speak. So going back to this kind of whole process, so we've just bought this lovely property in the Cornish coast or whatever. And, you know, it's basically, you know, we've done a little bit of refurb. So we've now got our you know, we can claim the sort of embedded things. We've done a bit of refurb. We can claim on that. What are and we're now running it as serviced accommodation, and we're looking to make a claim. Should we do it very quickly? How should we be feeling about these, you know, when should we approach you to come and help us out?
So typically you want to get in touch at the first instance, just so we can establish your entitlement to claim and make sure there's no restrictions to claiming. So that's the first thing we want to do. So when you're looking at a property, obviously get in touch then. You can book a discovery call on the website, and obviously we can go through the ins and outs of that. But then I would say, in order to actually complete the claim, unless there are extenuating circumstances, there are some circumstances, but more often than not, let's just keep it simple. I would rather you prove the concept before we claim the capital allowances, because serviced accommodation, as you know, isn't for everyone. Yeah, it's hard. There's a lot of legs involved. There's a lot of running around. It's a hands-on business, and it's not for everyone. And I think a lot of trainers make it out to be just, you know, the kind of this golden ticket item of commercial property that everyone can just jump on board and make stacks of bookings from. I've lost track of the amount of people who I speak to at the beginning who I'll say, right, get it up and running, hit the qualifying criteria. Let's talk again in about, you know, month 8 or month 9, and let's see where we're at. And at that point, I mean, I can only add value if you guys are smashing it. If the bookings are flying in and you've got a massive tax bill, then you call me and I'll do my best to mitigate that tax bill, right? And I can only do that if you're smashing it. So you need to prove that first. And the amount of people I don't hear back from again, because literally after 6 months, they're like, God, it's just too much. There's too much running around. There's too much of a headache, rah, rah. I'm better off just running as an AST. And yeah, maybe I won't earn as much money, but I won't have any of the headache either. And it's hands off, blah, blah, blah. So that's why we say, get it up and running, prove the concept, and let's talk in month 9. Because at that point, you could say, you know what, it is doing okay, but I'm not really going to have a massive tax bill, so I'm not going to benefit from the allowances now. So then let's just wait then. Let's claim the allowances next year and see what the scenario is then, and do it methodically to work with your cash flow as well, because we want you to be up and running, earning money. Because if I'm going to get involved, then I'm going to have a fee that you're going to have to pay. I'd rather not hit you at the beginning where you're going to be brassic anyway, having bought the property, got it up and running with the setup fees and everything else. The whole purpose of this is to add value, to make this business more viable, to allow you to retain more of your income so that you can invest in more properties and scale your business and take it bigger and better and all the rest of it. And the more you buy, the more I get invariably. So it's in my interest to make it work for you guys at the beginning and stack the numbers up in your favor. So I will set out like a guideline and a plan and a schedule for every single client individually to make sure that it works to their needs, because no case is the same. Everyone's scenario needs to be assessed on its own merits, and we do that accordingly. And we want you to incorporate this into your property strategy going forward, because if you're entitled to claim these allowances, then why aren't you claiming them? I mean, typically the service for me, you know, it's blessed because it sells itself, right? I mean, ultimately, if I speak to a client today and I say, right, I can save you £200,000 worth of allowances, which is due to go up, the corporation tax rate is due to go up to 25%. So on £200,000 worth of allowance of profits, you're going to pay £50,000 worth of tax, right? If they don't go for it on day 1, the day the tax return is due, they're going to come running, because they're like, okay, right, either I pay 50 grand to them or I pay you just a fraction of it and you wipe out the rest. So it sells itself. So if you're entitled to claim it, then why aren't you claiming this, and why are you not incorporating this into your strategy? Because your tax is going to become like one of the biggest killers in the country at the minute, just taking all of our money away unnecessarily. Allow us to just do this for you, at least retain your right to claim and keep that option open. Whether you choose to claim them or not, it's entirely up to you. But just don't lose the right to be able to claim that when you buy your property, because you'll only kick yourself later on. But that's all it is. It's just about adding value and just educating people and raising awareness around this subject, because our biggest issue right now is raising awareness. People just don't know about capital allowances. They don't know the significance of it. I still get accountants coming to me and asking me, seems like a scam. Like, how are you doing this? I want to see the workings. I'm like, well, no, it's my intellectual data. I'm not going to give you everything. I understand what I'm doing. Just because you don't get it doesn't mean that you can't do it, but you can do it. And that's how we typically get our work. We don't advertise. It's all word of mouth. So I'll do a claim for you. I'll submit it to your accountant. Your accountant look and say, okay, I didn't know you could do it on this level. I've got these other clients. Can you help them? Yeah. And that's how our business tends to grow. So it's just organic like that. But yeah, guys, seriously, something to take on board. I'm here for you guys to obviously bounce questions off and all the rest of it. But it is just about making sure that if you're entitled to this, you are fully utilizing this benefit and not wasting and paying out unnecessary amounts of money that you don't need to, that you can keep in your pocket.
Amazing. So basically what we want to do is inherently remember that with these capital allowances, you're offsetting basically tax payable on profits inherently. So we want to be running the business first, to ensure that we are making a profit, and it's a good size profit, to ensure that we then go through the process of claiming the capital allowances so that we can then offset that so that we don't have to. So a lot of people kind of think that it's a bit like money in the pocket day one, but it has to be that if that's your first property, then that's not going to count. Maybe if you've got more, I don't know, but inherently you want to be making money first, so that you can do it. And I absolutely love when you say raising awareness. I know we've had a recent case, haven't we, that we've been talking about with the developer, and we could save him hundreds of thousands of pounds, and he literally spoke to his accountant, who said that's a load of rubbish. And that was it. It was all quashed. The developer got really excited. He was like, oh, that's amazing. Yeah, definitely. That sounds great. And it was kind of, told that it was wrong. So I totally agree with you. It's really important to have that education and that awareness.
It was exactly that. That accountant just didn't get it. They know that you can claim capital allowances on, so where we add value is this. So a typical example would be this. Let's say someone's built a property, and they've fitted it out. Now, they give all of the invoices to the accountant. Now, the accountant will go through all the invoices. Everything's itemized and, scheduled out. And they say, right, we spent X amount on lighting, X amount on ironmongery, X amount on electrics, X amount, and everything's broken down. Now, an accountant can work with that and claim all those items because everything's done for them. It's all broken down. But then it's more often the case where an accountant will just get a builder's invoice that says, right, we spent £2 million on this property, and there's no breakdown. It's all just like that. And they don't know what to do with it. So they might just claim a nominal amount. But then we'll come in and we'll do a site inspection and we'll allocate that expenditure to all the different bits in the building and and identify the allowances based on that. And because we're dual qualified as accountants, tax advisors and as surveyors, we can do that. But the accountants aren't. So then when we come to them with the report, they're like, well, how have you done this? It doesn't make sense how you've done this. And they're like, you can't claim it based on this because, you've just quantified it based on stuff they've inherited or whatever it might be. And it's just raising awareness and educating them as well, because a lot of them don't get it. Some of my best accountant clients and referrers are those that were so standoffish at the beginning, that were really against me and were really nasty about it as well, saying that, right, you're lying about this. There's no way you can do it. Show me the proof of this and the other. And now they're just shouting about it from the rooftops, because now they're just fully, big advocates of the whole thing. It's just about, like I said, raising awareness about this subject and making sure these people are aware of it. But yeah, like your one, unfortunately, massive potential to claim, but just ignorance on behalf of the accountant and and then the problem is that the client will trust their accountant because they've been with them for years and they're their registered, proven, tax advisor. So, and who are we? We've just come out of nowhere and we've come out with these wild claims of what we can save them. And that's what it sounds like, just wild claims, but it's not. It was legit. And all they have to do is look at the Capital Allowances Act 2001 on HMRC's website, and you can see clearly that you are entitled to claim this. It's not like I'm making it up. It's there on the government website. It's all in black and white. So, yeah, crazy. Yeah. Unfortunate, but it's just one of the obstacles that we come across, unfortunately.
So when we're talking about that, just as thinking about that example, so inherently, so they built this development and they're just handing the invoices to the accountant, and he is not looking into that much detail, so he just makes an overall, not guesstimate, I'm sure it's a bit more than that, but he puts something. Whereas when we come and talk to you, you're literally looking at, so even if it's just an apartment block and there's some SA, within that, you've got the communal areas that you could be spending money, you could be claiming capital allowances. Obviously, there would be the serviced accommodation. So is it that kind of element with that example?
That's exactly it. So I've got a block of apartments in Derby at the moment I'm working on. And this client built this block of apartments and we did a claim for him based on the communal part. The communal part came to maybe 10% of the build cost, and we left it at that. But then his plan long term was to start transferring some of them across to service accommodation. I think he's up to about maybe 2/3 of it are across the service accommodation, and he's just waiting for the other tenants to kind of leave before he transfers those across. But we've been doing it in different tranches. So literally he converted 5 of the units to service accommodation. So we went back in and we just did those 5 units. And that was literally getting to every single nook and cranny and claiming capital allowances on that bit. So we've done the communal and now it's those 5 apartments. And every time he uploads additional apartments on there, then we go and do those as he does it. And systematically we'll end up doing the entire block. So yeah, there is a way to do it, and that's how we're doing with that one. And it fits in nicely with the example that you just gave. It's literally, you could be doing half and half. We would just prorate it against the portion that qualifies as running as that, and the rest will just be disqualifying or non-qualifying expenditure.
Amazing. And then you spoke about this first year relief. Could you give us a little bit more detail about that?
So it's called annual investment allowance, and the annual investment allowance currently is capped at £1 million, which is the highest it's ever been. And what that means is there is a benefit to claiming capital allowances in the first year when you incur the expenditure. Now, typically when you claim capital allowances, it's claimed at a percentage year on year. There's two pools of allowances, a main rate and a special rate. The main rate is currently 18% and the special rate is 6%. So let's say we find you £100,000 worth of allowances. On average of the two percentages, it'll probably be like 13 or 14% overall. So you would write off £14,000 worth of those allowances in the first year, and the remaining 86 will get carried forward to the next year. And then you do 14% of that the next year, and the remaining would get carried forward. And you'd keep on doing that on a reduced balance basis until you've exhausted the full amount. That's if you've incurred the expenditure outside of the first year. That's how you typically claim capital allowances. However, if we get to you when you
Sorry, you mentioned 18%, 6%, and then you mentioned 14%.
That's just an average of the two combined.
Oh, I see. Right, great.
Sorry, I shouldn't make that distinction. So just two of them combined. It might be that it's only 18% and it's only 6% because you only qualify for the one, because there are restrictions to claiming. But let's just say it's 18% for argument's sake. You're only claiming the main rate. It'll be 18,000 this year, the remaining 82 to the next year, and so on and so on. Now, with the annual investment allowance, if you've bought an SA apartment, or wherever it might be, or a block, or something that qualifies, and we identify allowances for you, whatever we find, you get 100% relief up to £1 million. So let's say we find you, say £500,000 for argument's sake. The full £500,000, because you've incurred that expenditure and we've identified the allowances and submitted it in your first tax return, or your first tax year, you qualify for that AIA, that first year annual investment allowance. That full amount will get carried forward into the next year, and so on until you've exhausted the full amount, and it goes in that first year, so you can get the full benefit straight away. So literally the first £500,000 worth of profits will be tax-free, and there's no percentage or writing down allowance because we've claimed in the first year. So there is a benefit to claiming in the first year. It's currently capped at £1 million. It's the highest it's ever been. I mean, there's been scenarios where it used to be 500,000, then they took it down to 50,000. So then they increased it to 250,000. Then they took it back down to like 100,000, and it just keeps changing. But it's at £1 million now. This is the highest it's ever been. So now is like the best time to claim capital allowances. Just recently, I mean, in COVID times, they introduced a super deduction, which is 130%. For every 100,000 that we identify for you, you would get 130,000 in allowances. Wow. But then they repealed that as of April this year. I have no idea why, because it was fantastic. It was such an amazing benefit, and it was only for new expenditure. So if you bought a property that was old, it wouldn't qualify. But if you spent money doing it up on new expenditure, on new building, then you could claim that 130%. And it was massive. But they've repealed that. They said they're going to bring in a replacement, but I don't know if they are. What they have introduced is a new system of full expensing. Now, full expensing brings capital allowances into the forefront of one of the best tax breaks you can get in the UK now. The only problem with the full expensing is this, though. The majority of the SME market, which is who we service, will still only benefit from that £1 million.
So just to clarify, SME is small, medium enterprises, yeah? Yeah,
of course, which is primarily our market. It's, the whole purpose of us working in capital allowances for the SME market is to bring capital allowances to the SME market, because this is essentially a tax break for the big boys, the blue chippers and all the rest of it. But it's not just for them. Everyone should be able to benefit. So we have that first year relief of £1 million. Full expensing really only applies to anyone who's incurring over £2 million worth of expenditure doing up a property. Now, those kind of clients for us are few and far between. There's not many aside from like the big kind of developers that are doing that. So then I wonder, why did they get rid of the super deduction, and why have they brought in this full expensing thing that doesn't benefit, as you know, hardly any of the SME market? Is it really just aimed at helping out the bigger companies and forgetting about the little people in between? It's insane. I don't know. I'm hoping they are going to bring something in for the super deduction. But yeah, watch this space. We'll see what happens. But that first year relief at the moment is amazing. I don't think they're going to repeal it anytime soon. If Labour get into power, who knows, maybe they might, but we'll see what happens.
Wow, amazing. So yeah, so inherently that first year, so obviously we talked about making money first, but obviously that would, if you claim it in that first year and you know you're going to make money, and you know everyone will know that I'm massive on choosing the right area. You've got your gold mine area, you're obviously running it really well. You want to make sure if you're running it yourself that you've done your due diligence. If not, you've got a really great management company who's running it for you. You will put it in that year because you know that, especially if it's multiple units, that will keep going until you've utilized that full amount.
100%, exactly that. And
what
if you have those allowances in a limited company, you can pretty much use the allowances to offset all of the tax bill for that limited company, regardless of whether you claim allowances in the other properties as well. So there is that possibility too. Again, something to discuss with your tax agent. That's probably the only version of sideways relief that you get with limited companies, in that you can utilize one set of allowances. You have 5 properties in there. You claim allowances on property number 1, the other 4 don't qualify, but you can utilize the allowances against the entire tax bill because they don't really differentiate between incomes in a limited company. It's just one tax bill. So you can do that as well.
But within an LLP then, or your own personal one, it would just be about against that one property, would it?
In that scenario, it's broken down separately, but in a limited company, it's slightly different. So yeah.
Interesting. Love it. Okay, so we have got some questions and I'm very aware of time. So we've got Nicole who says, who benefits from these allowances, property owner, or can the rent-to-rent company let benefit?
Typically, if the landlord is the one that owns the property, so they're the ones entitled to claim capital allowances. You get management companies and rent-to-rent companies who come in and spend money doing the property up before they start running it. If you've incurred the expenditure, you're entitled to claim the allowances. So if you spend money replacing a bathroom or a kitchen, then you're entitled to claim that expenditure for doing those bits up. But typically, if you've not really spent much money, the property was ready to go, and you've just come in and you've taken over, the allowances will only benefit that person who's incurred the expenditure, which is the landlord, so it's for them. But it works in regards to, obviously, if you provide the landlord with the information that they can claim capital allowances on the business of service accommodation, all of a sudden it becomes a much more viable kind of transaction for you, because not only are they going to give the property, but they also all their income that they're going to derive from it is going to be tax-free.
Okay, fantastic, fantastic. So next up, I think we covered the London stuff. Oh, this is an interesting one. So I think Matthew may have things mixed up, and I certainly do hear this a lot. He's talking about capital gains tax and capital expenses, and we're talking about capital allowances.
Yeah, capital gains is separate together. There's nothing we can do to offset capital gains, unfortunately. Capital allowances is purely about income tax. It's just income tax, and that's all we can offset. If I could offset capital gains tax, I would be on an island somewhere, and I wouldn't be saying running out doing site inspections, because capital gains is just insane. It's just a dead tax. Unfortunately, we can't do anything about to mitigate.
Okay, so Matthew, I hope that kind of explained that. Yeah, they're sort of very different, but they do have obviously very similar sounding names. I know there's he's put a thumbs up there as well. So again, just going back to the process and how it works. So yeah, we bought the property, we understand how everything works. We know that we've been operating for say 210 days, it's been booked for 105, we're making money. We can see this is an absolute success, and we're thinking, right, we don't want to be spending, we don't want to be paying out on taxes when we can offset that. So what do you do? So you mentioned that you come in at the beginning and then you do a survey. Can you just talk us through that sort of whole process of how a claim might work?
So,
and also, does it mean if it's abroad that you get to go and visit all these lovely places in Europe?
Yes, it does. It's amazing. It's so nice, seriously. So we did one in Lake Garda, and that was fantastic. It was so nice. We've done stuff all across the French Riviera. I've got one at the moment, which is in is it? God, where is it? Is it Tenerife? I'm not sure. It was Tenerife, or was it Alicante? I can't. It was one of those ones. So the guy's got one unit, and but he knows all of the guys that own all the ones next to it. And I said, right, because his one isn't a massive ticket item. I think he bought for like about 120, 130 grand. But he knows all the other guys, and they're all UK-based investors, and they all let them on the same basis as him. And I said, right, so if you get all of them on board, I'll do yours at like half price, and then it'll make the trip more viable. And that's what we're working on at the minute, because I want the other 9 in that 10 block development, basically. And that's how we do it. It's nice. It is pretty cool, but the only problem is they only make us survey them in the dead periods when it's freezing cold. So I went to Paris and it was just raining and hailstones. This is not what I signed up for.
But I love that. Isn't that amazing? So basically you've got somebody who comes to you and then he calls up the other 9 people who have no idea, and you basically say, I'm going to help you not pay any taxes on your income from that. That is like a kind of like a call of, you've inherited this, isn't it? I mean, that's a pretty amazing call.
Yeah, I mean, they weren't aware of it, so we're just raising awareness around that. So yeah, it's fine for them. It's all good. And they're keeping those long term. I think all of them have them as second homes, but they hit the criteria because they're let out for the majority of the year anyway. And we're just wiping out their tax bill because they're going to be keeping them long term anyway. And with the way the allowances work, if you do decide to sell the property, we can sell the allowances with the property. So there is a benefit in kind there as well. Whether you choose to give it as a benefit in kind to make the acquisition more viable for the new person or a lot more attractive, that's entirely up to you. But that's something else we can do. We get that a lot with mainly commercial properties there. So typically, actually, no, we get it with service accommodation as well. There was a block that we acted on recently where the guy was running a service accommodation. He had no intention of selling, but someone made him a really stupid offer because it was doing really well. And like we said earlier, he realized there was a lot of running around involved in the service accommodation thing, and he got the offer and he just thought, you know what? I can just make a quick raise here and walk away. And we transfer the allowances across with the business, basically, because ultimately, how much more viable is that? So you're going to buy this and it's going to come with a couple £100,000 worth of tax relief as well. How often does that happen? So it's a much more attractive proposition to the new owner. But yeah, essentially, we can work with the owners with regards to that. The process, as we said, go back is, so you come to us, we establish your entitlement to claim, and we do like a desktop assessment. So you have it in black and white and you know what the process is. And we'll just say that, right, this is what we're potentially going to find you on your property based on the information that you provided so far. And right now you just need to crack on and get it done. You come back to us and say, right, it's up and running, getting the bookings, I need the allowances. So what we will do then is, depending on the nature of the property, we will say, all right, send us full measurements and photos of the property, and we can complete the report as a desktop. Or if the property is a bit more complicated, and I'll do that based on, just a judgment call on the information that I received, I'll do a site inspection. More often than not, I prefer to do the site inspection because I don't want to miss anything. But service accommodation is really straightforward. It's not, we've been doing it so often, I know like back of my hands, and there's very little that we can miss. And if there are any gaps in information, the client can typically flag that off the back of a phone call anyway. And because I'm up and down the country anyway, if it's on my travels, I will pop in and have a quick look regardless. But we do a site inspection, we quantify all of the allowances.
Just to interrupt there. So when you say, I'm, you might miss something. I mean, to those of us who don't know, what to a layperson, what might you see that, say, somebody else might not see?
To be honest, you only tend to miss things, or we only tend to miss things on the lower end properties. The higher end ones, the offices, the care homes, the hotels, and everything else, they're easy. It's crazy. It's the smaller ones, like, the small apartments where we need to squeeze every bit of value we can out of it. And that's what a site inspection does. And sometimes the properties are a bit complicated. If it's just an open plan apartment, easy. But if it's like a house that's got a basement and got loads of little kind of crevices and everything else, that's where you kind of miss things. There might be a boiler in a hidden location. There might be a gas meter somewhere that, you can't really see with a video walk around. There could be those kind of things. And that's the stuff that we want to get. There might be an MCB board somewhere hidden away in a back room that is just dark and it's not, open to the clients when they come to visit the property. So I'm not going to see it in any of the photos. So that's the kind of stuff that we want to make sure, because all of that stuff is value and we want to quantify all of that and include in the report. So we don't want to miss anything. And that's why I say that we want to be careful. And it really is on the kind of where the margins are tight that we want to maximize and benefit, add as much benefit as possible. So that's what I mean. It's rare that we miss anything of any significance, but we just want to make sure that we're providing the best service we can. So we quantify the allowances, we produce a HMRC compliant report, we submit that to you and your accountants. Your accountant will have a week or so to go through it, come back to us with any queries, and then they submit the figures into your tax return. We're on hand to provide submission guidance with regards to how they submit the allowances. And if worst case scenario, there is a HMRC inquiry and they come back and they ask questions around it, that's for us to deal with. It's not for you, your accountant, anyone else. We've done the report, we've quantified the allowances, it's only for us to respond. So they will write to your accountant, your tax agent, but they just send it on to us. I'll draft the response and I'll send it back and they'll just be the go-between. They can inquire into the allowances at any time. There's this myth where, they've only got 6 years, they can do it at any time. So if they decide to do it in 10 years time, then you still just come back to me and I'll do it. And fingers crossed I'm still around in 10 years time, but that's for me to deal with. And the terms and conditions that you sign guarantee you for the lifetime of the allowances as well. And there are no hidden fees. Once we typically just charge a percentage of where we identify. So for example, if I charge you 5%, it'll be like on £100,000 worth of allowances, the fee would be £5,000 plus VAT. There are no additional costs for any inquiries or anything else. It's all covered in that one fee, and that's for the lifetime of it. And that's it. It's as straightforward as that. I mean, anyone who's listening and anyone who's running service accommodation and is looking to claim capital allowances, your main criteria here is to just be earning as much money as possible. And then it's my job to come in and try and wipe out the tax bill that you guys are due to pay. Unless you guys are smashing it, I can't add any value. So that's it. That's your number one thing. So when everyone comes and says, I'm buying this property, what do you reckon? Everything else, they go, what do I need to do? I said, smash it. Just go out and do what you have to do. Get the bookings, get this business as profitable as possible. And that's when we can add value. If you're not doing that, there's nothing I can do for you. That's it. That's your number one aim. And that's all you have to do. Yeah.
Okay. So we've got another question from Andrika. If you renovated a property, say 7 years ago, can you still claim if you can't find all the invoices? How do you value the property? Is it via land value?
So if you don't have the invoices, there will be an addition in your accounts. So the account would have put some kind of like a fixed asset. There'll be a fixed asset register. There'll be additions that go into the accounts. So they should have that. Unfortunately, if you don't have any proof of any expenditure, then we've got nothing to work with. So whilst I say we can go back as far as you know, whatever, like I mean, I'm doing a portfolio for a client and he bought all of his stuff in the 70s, so you can go back whenever. But we do need evidence. We need something to work with, because HMRC will invariably ask a question as to, right, on what basis have you done these allowances, and what quantify that way. And I need to be able to back that up for you, because I'm not going to take on anything and put myself or yourself at risk. So we do need some kind of evidence. So if you can find something either in your additions with your account in your fixed asset register, that's all I need. I just literally need for the account to say, right, they spent X amount, I don't know what on, but they spent on this year and we capitalized it, not done anything with it, then I can work with that. That's fine. You may find that your account will have taken those expenses or whatever else and revenued them in your account and claimed them as expenses. Got you some benefit that way. That might also be done. So it would warrant a conversation with your accountant to clarify what they did with that expenditure and how they treated it. Because I think some people don't realize that their accountants, they don't have to be, you know, specialists in capital allowances. If they've got an invoice for something, you know, blatantly, and it says that, you know, replacement of bathroom or kitchen, they could have just claimed capital allowances on that and put that through and just maybe not made you aware. They could have done something as simple as that. It's only when there's no breakdown and yeah, they don't know what to do with it that we come in and we add value. But yeah, I would say in that scenario to Andrew, I think his name was, find as much evidence as you can, because I need something to work with in order to prove that obviously that expenditure was incurred. Yeah.
So what is it? There's something about a two years though, somewhere or other in capital allowances, isn't there? If you've bought some plant and machinery and you haven't claimed it within 2 years.
So that is mainly for fully commercial properties. So say, for example, you're buying an office and it's, you know, been running as an office for whatever, and the prior owners were entitled to claim and so on. The rule change came in April 2014. It's called what's called a Section 198 election. And I think this was all brought in to avoid double claiming and keep some kind of register of capital allowances. Because right now when people say, oh, is there a register where I can check if anyone's claimed capital allowances? There isn't, basically. And I think this is the method by which they've tried to get that covered. But it is just such a pain in the arse. It adds no value whatsoever. It just causes more problems than not. And again, it's just another thing brought in to restrict people from claiming capital allowances. So we get, and now enough time has passed now since 2014. We're getting this a lot now. So someone will come and they'll say, right, I bought this property in 2017. I've only just found out about capital allowances. So what can I do? Did you pull the allowances at the beginning when you purchased it? No. Okay, so you would have had a 2-year window within which to do that with the vendor you bought it from. Now, no one's claimed capital allowances on this property before in the past, and you own it right now, so you're entitled to claim it. But because no one made you aware of it and you didn't pull it within the 2-year window that you had, they're gone forever. Literally, they're lost. There's nothing you can do about it. It has to be done within 2 years. So they give you a 2-year window within which to do it. But in real terms, from experience again, and being on the ground, unless you do it at the point of completion and exchange on the property, you're not going to get that vendor to sign it, because ultimately that's the only leverage you have at that point of sale. Afterwards, going back and say, can you sign this? They're done. They don't care. There's nothing in it for them. There's no mandatory requirement for them to sign it, so they're not going to assist you. So we usually put a time frame like, you will assist us. We put some clauses in the contract saying that you will comply with our request for information and sign this election upon completion, and it'll be done within a 3-month period, so we get it all done. But yeah, unfortunately, there is that rule now. It doesn't apply too much to SA, because you're buying essentially residential properties and converting them across, so there's no restrictions, as we said at the beginning of the meeting. But there are scenarios where people are buying running SAs, and in that scenario, if the prior owner was entitled to claim, then you do need to do a Section 198 election with them. That Section 198 election, what that is essentially, it's just a document that has your tax reference details on it, the vendor's tax details on it. We identify the allowances, we put the figure down, and you both sign it. They will attach it to their final tax return, which will be their disposal year, and you'll attach it to your first one, which will be your acquisition year. And that's it. Sounds more complicated, but that's all it is. And that's the method by which it's transferred across. But then again, the catch-22 there is, if I give your vendor a document and it says like £50,000, they're going to look and say, well, why the hell am I signing this? Why am I not claiming this? I'm entitled to claim this. And there's nothing you can do, because then you get stuck there. They're disposing of the asset. They can't claim all of it anyway. But in order to get around that, you might need to give them some allowances for their previous year, the last open amendable year, because they can go back 2 years. I wouldn't want to do that. I never give any allowances away again, because why should we? They never paid for it. You snooze, you lose. They missed out. You've identified this kind of tax break, and you're taking advantage of it. And now they're annoyed because they missed out on it. That's not your problem. But yeah, it is a bit of a sticking block that we're getting more and more now, because enough years have passed for this to start becoming a major issue. And we're getting more and more people coming out of the woodwork and saying, right, I'm going to sue you now because you're my conveyancing solicitor. You never made me aware. I've missed out on £300,000 worth of allowances. I have to pay 60 grand in tax, all because of your negligence. And it is massive negligence. So yeah, that's the 2-year rule, unfortunately. Doesn't impact SA too much, only in certain scenarios. But yeah, for commercial property in general, which is what a lot of people after service accommodation do move into because they move to bigger things, something to be aware of. There is a 2-year window within which to claim these allowances. Otherwise, they are lost forever. So even if you buy it, you're entitled to claim it, you flip it, the next person might come after you because you've not done anything with it. So again, when I say incorporate it into your property strategy, it stops you from being negligent and compliant with all the kind of rules that are coming in.
So it sounds like that if the only instant where you have to be very aware is if you're buying an already running serviced accommodation and they haven't claimed the capital allowances yet. So
Exactly.
maybe a holiday cottage that somebody has just, you know, it was their second home and they just ran it and they're not experienced or knowledgeable, like the people clearly who are here. Fantastic. I see we can run over, but I did just want to ask one question with regards to your portfolio that was bought in the 70s. So you spoke about obviously, you know, when you purchase a property and everything that's in it at that moment. And we talked about a value of being 350 to 400,000. Now, obviously, when he bought them in the 70s, they would have probably been like a couple of £1,000s for a property. So how does it work when you have such a low value when you purchase the property?
Sometimes it works. For him, it kind of works only because all of his units are in East London. So I've got one which is like a really tiny, narrow kind of phone shop. You know, like you see them, they're just tiny. There's nothing in there, right? He bought it for 89,000 back in 1979. It's worth like 1.2 million now. It's just a shack, right? But there's not 1.2 million pounds worth of value in there. So to be fair, the 89,000 pound purchase price actually works for that scenario because there's probably just about that much kit in there. But essentially we're restricted to the purchase price. So we have to do it based on the purchase price. And that's where it kind of gets a bit muddy. I mean, a completely separate example, I did one in Wales recently. A guy bought a business centre. It was huge. It was absolutely huge, beautiful, amazing. Like there was a science lab there. There was multiple service offices, everything else. He bought it for like 450 grand. It was insane. It was immense, the amount of kit in there. Once we did the capital allowances claim, the actual integral P features came to like about 1.5 million. He only spent 450,000. We have to artificially dumb down the allowances because no way HMRC are going to let it through. But he massively underpaid for what it was because I don't know how he did it, but it's insane. And then we have to just artificially dumb them down because there's no way we can submit a claim of that value. So that scenario with the old purchase prices is similar to that, where it's just an undervalued thing and we have to artificially dumb down the allowances just to get it through HMRC and under their radar, because no way they're going to accept something where it's going to be like 90% of the purchase price, because it's just not possible. But it's ridiculous because we do at today's replacement value, not at the replacement value then, and we apportion our allowances and prorate it against the purchase price that you paid for it. That's how we derive the allowances. But yeah, we do have those scenarios. They're few and far in between, but boy, are they tough. They are really hard, those ones, because it's like, what did you do? This is insane. But yeah, some people get lucky and buy stuff of that nature.
Amazing. So look, guys, I've popped Usman's website. It's linked at the top of the Clubhouse, and for those who are on live, Facebook Live, we've put a link to it there as well. And for those of you on YouTube, we'll put a link in as well. So if you want to find out, remember, guys, that your accountant, they're great at what they do. Well, hopefully they are. They are, you know, they are more kind of generalists, and this is a very niche, very specialist thing where you really, to get the massive returns and the massive benefits from it, you want a specialist. So obviously someone like Usman, who's clearly extremely knowledgeable. And what I have never had to do before, Usman, is I always listen to things at about 1.5, even 2 times the speed. But for you, I think we might have to dumb it down a bit and have it on a 0.5 because you do speak very fast.
Well,
so
look how much value you're getting.
Exactly, you've got like double the amount in the time, so we can see that as a real benefit. And how fortunate are we nowadays where we can make people speak as fast or as slow as we want them to be. So I think that's a real benefit.
Thank you for having me. Thank you for everyone that's on board. I am on the socials, guys. You can find me on LinkedIn, Facebook, Instagram. I do try and vlog as much of like the site inspections, the journey that we do, just so you can see real life examples and see what kind of stuff we do. And it does help with the education as well, because more often than not, people will see a video and they're like, okay, I've done that as well. That applies to me. So yeah, LinkedIn, Usman Nazir, JNC, same on Facebook. I think it's Uzi Lad on Instagram. I do try and document as much as I can. I'm really poor at vlogging the stuff, because what happens is I can't do double takes. I'll record it once, and if I get it wrong, I'll just say, oh, sorry, I tried, and that was it. And then I kind of crack on. And more often than not, when you're doing stuff in London, someone will always try and photobomb and I can't record and leave the bits in where I start fighting with them and swearing at them.
It's not a professional look, is it?
Just say how I abused someone whilst they messed up my video, but then no, that didn't go down too well the last time I did it. So yeah.
Fantastic. So guys, please, if this has been really valuable to you and this has been valuable content, please follow both of us here. Usman is brand new to Clubhouse, but please do go and find us on the socials as well. As I say, this is on replay here on Clubhouse, but it will also be within 24 hours onto YouTube, where you can go, and please do subscribe there. I'm really pushing to get 1,000 subscribers, so I'd really appreciate your support if you could come. So it's Emma Howitt Pure Abodes in YouTube. So again, Usman, thank you so much for your time. I'm very rarely run over, but we have, because we did have so much, and as you say, what incredible amount of information that we have squeezed in just over an hour.
A lot. So guys, if you have questions, feel free to reach out on the socials. There are always stupid questions, but like, you know what I mean, as in like there'll be scenarios. Don't be shy to ask a question. Ultimately, I'll be more than happy to assist. I just need basic information. I can assess your properties, and we can go through whatever. So even if it's stuff that you're looking at purchasing, just drop me a line and I'll be happy to do a little quick assessment and say, right, this is what you need to do, rah, rah, rah. And it'll just give you just that bit of kind of peace of mind knowing that you're on top of something and you've not missed out, basically. Yeah.
Amazing. Well, I have to say, we do often get a bit of drop off, but everyone has literally sat here glued to their seats listening to us. So yeah, really appreciate that.
Thank you. Thank you for coming down. I look forward to connecting with all of you online. Thank you. Thanks, Emma.
Take care, guys. See you soon.
Cheers.
Bye-bye.